This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, we're still looking at the various different ratios you could be asked to calculate. In the previous lecture, I went through all the profitability measures. Now we'll look at liquidity and risk. So first of all, liquidity. Oops. What we're looking here at is how easy it is for the business to be able to pay its bills in the short term. You can have a business that's very profitable, but if it runs out of cash, then there's always the danger that they may be forced to close down. And there are several ratios here. The most important one is something called the current ratio. And you've got the formula there. It's the current assets divided by the current liabilities. So let's just check it in both years. In 2010, the current assets are 5553. The current liabilities 2316. So in 2010, the ratio error. 5553 divided by 2316. The ratio is 2.40. I'll interpret it in a minute, but in 2009, the arithmetic, it was 4029 current assets divided by the current liabilities 1690. The ratio was 4029 divided by 1690. 2.38. Now, this is one of the only ratios which makes sense on its own. If you remember the others, it was really comparing. Was it better than last year? Was it worse than last year? Or comparing with similar companies. The current ratio, surely for a company to be able to pay its bills in the short term, the current assets must be greater than the current liabilities. And so it must be more than 1. If ever you had a current ratio of less than 1, then we've got huge problems. Or in fact, a current ratio that's getting very close to 1 is a worry. Here, 2.40 obviously doesn't appear to be any problem in the short term. And it's hardly changed since last year. If it gets very high, and then it could be rather inefficient. Very high would be suggesting that they're keeping very large levels of inventory. And the danger with that is they might end up never selling them, if they've got too much. Or it could be that they've got very high levels of receivables because they're giving customers too long to pay. However, there's no sort of upper limit. It depends on the type of business. And so here we can't say whether 2.40 is it's certainly not bad. We can't say particularly good. We'd need to compare with similar businesses. The next one is very similar. The quick ratio, or as you can see, the acid test ratio, is exactly the same idea, but when we're looking to see if we can pay our bills, maybe our payables, maybe we have to pay them in a month. Well, if we've got some cash, we can pay, no problem. There's receivables. We haven't got the cash, but hopefully we'll get that in, perhaps within the month as well. Inventory, though, will take longer because in order to get the cash from inventories, first of all, we need to be able to sell them, and that may take several weeks. And then, of course, if they're sold on credit, it'll be several weeks longer before we actually have the cash. And so, but we need to pay payables perhaps sooner. And so, quick ratio, exactly the same idea, but we exclude the inventory. We take the current assets minus the inventory and divide that by our current liabilities. So what was it? In 2010, If we exclude the inventory, we've got receivables 2275, cash 864, 3139. We've got current liabilities 2316, and so the quick ratio, I get 1.36. And what was it last year? Receivables 1699, cash 240, so a total of 1939. The current liabilities 1690, and so 1.15. Well, again, I think obviously you'll expect that to be lower. It'll always be lower than the current ratio, but the same principle applies. To be sure we're going to be able to pay our bills in the short term, again, we'd want it to be more than 1. And it is here. There's no sign of any particular problem. All right, we can go into a bit more detail in that what's next. You'll see next inventory days, receivables days, payables days. I said earlier that if the current ratio is very high, it could mean that we've got huge levels of inventory, more than we actually need, or we've got huge levels of receivables because we're giving them a long time to pay. Well, we can look at each of those in turn. And I've done a slightly different order. Perhaps the most obvious one, to be clear what we're doing, is to look at the receivables days. Or the average collection period. And here we're going to estimate how many days credit we're giving to our customers, how many days it's taking them to pay. And so what is it? Well, we know what the receivables are. At the end of 2010, receivables are 2275. We know what the total sales are. The revenue from the statement of profit and loss is 17,232. And incidentally, in the exam, make the best use of the information available. We should be looking at the sales on credit. If we were given a split, it's the sales on credit we're after, but here we're not. We've no choice but to assume that all sales are on credit. So our receivables are that proportion of the total sales. And on the assumption there are 365 days in a year, sorry, this is 2010, it would appear that we're giving them that proportion of a year's credit. So 2275 divided by 17,232 times 365, I get 48 days. How long were they taking to pay in 2009? 2009 receivables was 1699. The total sales, the revenue 13,044. And so last year 1699 divided by 13,044 times 365. 47.5, again to the nearest day, 48 days. Now, a few things there. First of all, you can't really say whether giving them 48 days credit is good or bad. You know, again, you'd need to compare with similar companies. You want to collect your money in as soon as possible. But of course, if similar companies are giving 60 days credit, then unless we give similar credit, the risk is we'll lose customers. So unless it's extreme, you can't really say if it's good or bad. You want it to be as low as possible. The faster you collect your money in, the better. So if it was going up, I'd want to know why. I'd perhaps be a bit worried if it was going down. If you like, I'd be happy. One other thing, and this is a general point, it could be a bit misleading in that we've taken the receivables at the end of the year, and they could be unusually high at the end of the year. Maybe we've only just sent a whole load of invoices out, or for that matter, they could be unusually low. It would be better to look at the average receivables over the year. However, we're not normally in a position to do that. I know here you could do for 2010. You know what you were at the end of last year, at the end of this year, you could take an average. But you couldn't do it for 2009. We don't have the information. It wouldn't be a fair comparison. And so normally, even though there's a reservation, normally we do take the end of year figures, the figures from the statement of financial position. Well, in exactly the same sort of way, for the same sort of reason, let's look at the average payment period over payables days. And exactly the same sort of logic that for payables days, the payables in 2010 are 2316. Now again, see what information's available. We should divide by the purchases on credit. Usually you don't have that information, which means you must divide by purchases and assume they're all on credit. But here we don't even know what the purchases are. If you're told purchases, you use it, but we're not told. We're having to assume that it's the cost of sales. There's no choice. Now, some people say, oh, but I can work out purchases, because if I know the opening and closing inventory, and we know what the cost of sales was, we can work out the purchases. But again, the problem is, although you could do it for 2010, you can't do it for 2009. There isn't enough information. And it wouldn't be comparable. So as I say, if you know credit purchases, use that. If you're simply told purchases, use that. If you're told none of it, you have to use cost of sales. But anyway, for the same reasons as receivables, it's that proportion to 365. Where are we? 2316 divided by 12924 times 365. I get 65 days. Whereas in 2009, liability is 1690. Cost of sales, 10109. Which is what? $365 days, hold on. 1690 divided by 10109. 365. That's better. I get 61 days. So, I mean, it seems to be taking quite a long time of credit. What's that, 2 months? In some ways, you want that to be as high as possible. The longer you delay paying people, the more you keep kept cash, which can be earning interest for you. Except if it gets too high, if you delay payment too long, then there's a danger that suppliers will refuse to sell things to you. If you're taking 5 months to pay, they're going to stop selling. Here, it doesn't seem too much of a problem, but again, you'd really want to compare with similar companies. And also, it's useful to compare those two, because surely any business would want to collect money from its customers at least as quickly as they're paying their suppliers, which here they are. They're taking 65 days to pay suppliers. they're collecting money from customers in 48 days. Finally, I said I was doing them in a different order, so back to the previous one. Inventory days. Oops. I did mention earlier that we don't want too much inventory. If you're carrying lots and lots of inventory, the danger is it'll take ages to sell it, and stuff may go out of date. You know, you might never sell it. But how much is too much? You know, the more you're selling, the more inventory you're going to need. And so, inventory days is a measure of how many days worth of inventory we're holding. We take the inventory, which in 2010 is 2414, divided by the cost of sales. Remember, inventory is valued at cost. So cost of sales 12924, again times 365, gives me 2414 divided by 12924 times 365. 68 days. Whereas in 2090 inventory, cost of sales 10109. 2090 divided by 10109 times 365. 75 days. Now, yet again, it makes more sense to compare with similar companies. You know, a firm of accountants who have virtually no inventory. A company that builds houses inevitably have a lot more inventory. So there's no sort of correct level. You want to keep it as low as possible within reason. Here it has fallen, but you can't really say much more than that. All right, well, those are liquidity measures. Finally, the risk measures. And again, I want to do them in a different order to explain what I mean by the risk. They're all to do with our borrowing. And the first one I want to look at is interest cover. Clearly, if a company's borrowing money, they're having to pay interest. And if they can't pay the interest, then the danger is the lender will force them to close down. They go bankrupt. So interest cover, we take the profit before interest. The profit in 2010, the profit from operations is 1896. And we divide by the interest. Well, finance costs is another word for interest. So 120. And 1896 divided by 120 is 15.8. And what does that mean? It means, we'll look at last year in a second, but it does mean that our profits before tax and interest are 16 times the interest. And so, you know, we don't know what's going to happen next year. Next year, profits may be lower, but profits can fall by a huge amount before we're not able to pay the interest. And so if that got very low, you know, if the profit was only 130, okay, we can pay the interest, but only just. And it would mean that next year, it would only need a tiny fall in the profit. We couldn't pay the interest, we might have to close down. It'd be much more risky. Here, no problem. I say profits may be lower next year, but the chances of them being that much lower are clearly fairly small. What was it the previous year? Profit before interest, 1108. Interest last year, 125. 1108 divided by 125, 8.86, 8.9. Well, again, we're easily able to pay the interest last year. This year, it's even easier for us. And so, there doesn't appear to be any real problem. But Albert made the point, if that got low, then things become pretty risky. You know, if the profit happened to fall next year. Well, that's caused by the interest. What we're looking at is the interest that we're paying. And why are we paying interest? It's because we're borrowing money. These non-current liabilities, these loans that we've got. And so there are two other ways we can look at the amount of borrowing in the company. And they're both very similar. First of all, what's called the gearing ratio. When a company raises money, they either borrow it from shareholders, or of course, they borrow it from long-term debt, long-term borrowing, non-current liabilities. And that's what they've got to have to pay this interest on. And so with the gearing ratio, we simply look to see what proportion of the total borrowings are coming from debt. So in 2010, the long-term debt was 1,200. What was the total long-term money, the total long-term capital? Well, from shareholders was 5255, sorry. From debt, 1,200. So the total long-term money in the business is the two together, 6,455. What proportion of that is coming from non-current liabilities? Well, 1,200 divided by 6,455. I get 0.185, 186, or 18.6%. Before I say any more, in 2009, what was it? Long-term borrowings, the current liabilities 960. The total capital, share capital plus non-current liabilities. So the proportion that's long-term borrowing, 960 divided by 4,321 is 0.222 or 22.2%. You can express it either way. Well, think back to the interest cover. Surely, the higher that figure is, the more money is coming from long-term borrowing, and therefore the more interest is payable, and therefore the more risky. Here it's actually fallen. It makes things less risky, but the difference isn't significant. And there's no what you might call best level. You will see in later exams, you can be asked to write. Well, there's a lot of theory relates to this, but that doesn't come till paper F9. Finally, less common, but same idea, it's more American, leverage. It's really another way of writing the same thing, but instead of saying how much of our total is from debt, we'll do the other way around and say how much of the total is from shareholders. So in 2010, from shareholders is 5,255. Out of a total long-term finance, as before, which gives us 5,255 divided by 6,455. 0.814 or 81.4%. And if you think the gearing ratio leverage, they add up to 100%. One's looking at the proportion of debt, the other at the proportion of equity. It's the gearing ratio that's more common, but otherwise it's effectively the same idea. Finally, what about 2009? Equity 3361, 3361 plus 960. 3361 divided by 4321 is 0.778, 77.8%. So I think I've said enough. As far as gearing's concerned, the higher it is, the more risky things are. As far as leverage is concerned, the lower it is, the more risky things are. The lower that is means the higher the debt. Okay, jolly good.